Have you ever wondered why a trading robot or a trading strategy more generally stops working? The answer is the market regime changes. So, what is a market regime? And in this video, we're going to go over that question and explain the concept of market regimes to you so you can better understand when to adapt a trading robot or to adapt your trading strategy more broadly. So a market regime can be defined as a period of time in the financial markets or any financial market where price action exhibits a certain behavior. And it's typically a longer duration period of time. And this behavior is caused from some sort of fundamental reason. So a great example is if you're in a rate cutting cycle, so the central bank is cutting rates, you might be in more of a bullish market period because this could be adding additional fiscal stimulus to the fire. However, we could maybe be in a very contracting market environment where monetary policy is getting tighter. And if this is seen as negative for certain types of financial markets, we could see price kind of entering more of a bearish period. So another great example would be Donald Trump. When Donald Trump is in office, we typically see significantly higher periods of volatility just due to his nature of governance. And this could kind of be a Trumpian market regime, where we have periods either bull markets or bear markets, but characterized by significantly greater volatility. So a regime should not be thought of as a day or 2 days. It should be in like a more meaningful time period, which is usually linked to some sort of underlying fundamental event. They can be faster, like this previous April, where we had that massive V-shaped recovery. The initial tariff shock could almost be seen as its own regime. However, we could also look at the entire recovery from the pandemic. We had this consistent massive uptrend, and this could kind of be linked to more fiscal stimulus and continuous quantitative easing, money printing, which just caused markets to go up for a very long period of time. So that's what you should think of when you think regime. So now let's go through the three largest types of regime and talk about what kind of strategies and expert advisors work well in these periods. And this is honestly the biggest reason why I find that a portfolio of EAs is a lot more robust than just using one magical EA forever. Because ultimately, and the ones that we use are more fundamentally driven, if you're in the wrong market environment, they won't trade. They'll get out of the market. And they'll essentially pick whatever market is in a regime which is favorable to the given strategy. So the first regime, which everybody likes, is the uptrend. And this is typically a fundamental period of time where things are going well. So you're seeing consistent higher highs and higher lows, a really clean trend up. And this is often referred to as a bull market. And this is a period of time where many investors bet big and make a large chunk of their returns. If you're in a significant clean trend up, you can usually have very high risk reward trades. It also just makes a lot of breakout style or trend following systems significantly better. If you ever read the Market Wizards book, you can see that a lot of guys in the 80s made a ton of money trading this style of system, more 70s and 80s, because commodities were trending. And they essentially capitalized on this clean trending price action with trend following EAs, and not EAs, but back then it was manual trading strategies, but systematic, to make a ton of money. So that is an uptrend, clean trending price action up. And this is a great time to bet big because you're in a bullish market. The sister to the uptrend is the downtrend. And the downtrend, depending on how fast it is, it can sometimes be like a panic sell-off. Great example would be the 2020 initial or 2019 initial shock. We can also see that now with the initial tariff shock in April of 2025, we had this really just rapid sell-off where markets collapsed seemingly in a few days. And this can be a fantastic opportunity, particularly for discretionary traders. If you ever listen to Lance Brightstein, who used to work at Trillium, they talk a lot about how they just made an absolute bucket load of money during the C-19 pandemic because there was so much panic that it created massive amounts of edge. Us as EA traders and more systematic algo traders can also do extremely well during downtrends, but we have to be very cautious because the level of volatility which exists in these massive sell-offs can be outside of the scope of the data which the bots were trained on. So if you're trading something like a grid style system, which is used to relatively modest moves, if you enter a panic sell where all of a sudden the daily range is 10 times higher than it normally is, the bot might not be able to adapt to this. So you need to just be very mindful of when you enter a panic sell. Yes, certain bots can do extremely well. Breakout systems also love this because it's just a downside breakout. But if you're running any sort of grid system or averaging in system, you have to be really careful because the magnitude of the move can be much larger than it typically is. Going now to the final one, the range-bound style of price action. Most traders hate this because unfortunately you don't have those big clean moves which can give you extremely high risk reward trades. However, a certain type of algo trader actually loves this strategy because it works great for grids. And if you look at, like, for instance, an Aussie New Zealand dollar pair, the reason why most people use that with grid systems is because it tends to move sideways. And this is an element where you can essentially trade some sort of mean reversion system, or even if you do more of a fundamental based entry, maybe you're looking to enter more with like a limit order and kind of enter at the, like for instance, go long at the low of the previous day if you have a bullish bias for the day, or go short at the previous high of the day if you have a bearish bias for the day. So range bound, we can also make money doing this, but it's a bit more challenging. Maybe we size down during these regimes, or we look for markets which are in a cleaner trend, or alternatively, we have to kind of shift our approach. But the main takeaway here is that if you buy a bot which is fully trained and optimized in uptrend, and all of a sudden we enter a downtrend, you might need to be a little bit cognizant of that. It might still work depending on if it's very selective and only buys on bullish days. But especially if you're dealing with purely technical, like data mine style strategies, you really need to be aware of what type of regime we're in, because then you're able to kind of mix and match. So fundamentally, this is why I like more fundamental swing style systems, because you know what regime you're in, you know which one should be working, and you're able to assess why something's working or not working. But when I used to trade more like purely technical analysis based systems, this would always be a little bit of a headache because something works great and it doesn't work. And understanding this concept, I found, was critically important to being a better trader. So guys, hope you enjoyed this video. Leave me a comment if you have any questions, and I'll see you in the next one.